President Trump meeting with manufacturing CEOs on Thursday. After that meeting, Dow Chemical CEO Andrew Liveris spoke with our own Neil Cavuto about that controversial border tax proposal. Listen.
We are pro-border adjustment tax. Every country in the world pretty much has a VAT of some sort that plays like a border adjustment tax. It's totally not fair that we pay something going into one country, yet as an importer, whereas they don't pay anything coming into this country. So I believe some pay-for like that is in the offing from the President and the Cabinet secretaries involved.
MD Sass CEO Martin Sass joining us now. You know, Marty, there's been so much talk about this border tax, but it really hasn't any impact on the market yet. Is this something we need to be concerned about?
Well, I think we have to be mindful of the winners and losers from it. And we've totally avoided retailers. We don't own one retailer. And apparel companies. These guys are going to get hurt by a border adjustment tax. There's, you know, obviously pluses to it for those that produce in the United States. It's going to encourage more production in the U.S. and also to balance the budget. You know, with big tax cuts, we need an offset. So, so the border adjustment tax is one of those mechanisms.
So here's my question about that. I agree with you. The retailers are going to get absolutely decimated, and you could see a lot of bankruptcies as a result of this because they're barely, you know, getting by as it is.
Right.
But how big an impact is it going to have overall in terms of market sentiment and also our fundamental economy, because we employ a lot of people in the retail sector?
Right. You know, I think it has a net, if you look at it in isolation, a net negative impact. So, I mean, particularly you look at the small consumer, the small, you know, lower income people, they're going to be hurt the most by this because they're going to pass
on this. Prices are going up?
Yeah, prices are going to go up and it's going to hurt them. So,
but Donald Trump's a smart man, and he understands business, and he understands the fundamentals of the economy.
Right.
You know, and I think there's a lot of smart people in the House as well. Are they not thinking this through?
I think he's getting mixed feedback on this. So he was negative on it and then turned positive, and who has his ear last?
That's an excellent point.
And that, you know, that's where you're seeing this conflicting.
So Marty, you know, much like Dan Skelly at the top of the show here, you're a stock picker, and you've been very successful in identifying trends and where to put money given what's happening in terms of the global economies. Right. You're avoiding retailers. Interesting, Skelly also avoiding retailers. What do you see as your best idea to take advantage right now of the Trump view of how we see the economy and we see the world?
Right. I'm actually being a contrarian, one who likes to buy stocks when they're hated.
Right.
Great companies at very cheap values.
Right.
And sell them when they're loved. I'm going to give you the most hated group and the most hated stocks. And they've been very poor performers. And I think they're extremely cheap. So the whole specialty pharma and biotech sector has pockets of extraordinary opportunities because Donald tweets about, you know, monopolistic drug pricing. They threw the baby out with the bathwater. And so the Valiants and Turings who had excessive price increases, they deserve to get hit. But companies that I'm going to suggest, which is Shire, Celgene, and Allergan, three stocks which we have large positions in. They have double-digit earnings growth, very visible for the next 5 years, minimum. 22% compounded annually for Celgene, 15% compounded annually for Allergan, 12 to 15% for Shire. Celgene is 13.5 times our estimate for 2018. And this is on organic growth. It's not assuming buybacks. It's not assuming acquisitions. Allergan at 15% growth is trading at 12 times, and Shire at 10 times. So they're trading at half the multiples of consumer staples companies, which are also recession resistant, but they don't grow.
Right.
You know, they're not growing at all. They grow 1%, 2%. These companies are double-digit growers, selling at half the multiples and selling at discounts in the market. The market is excessively pessimistic about what this administration will do. I don't think they're going to impact these companies at all.
Why is the bond market not buying into this growth story. I mean, we just had German 2-year bonds at record lows this week. U.S. Treasuries continue to tell the market message that we're not going to see the kind of economic growth. Why the disconnect with the bond market?
I think I think we're in a bear market for bonds after a 35-year bull market. I think the bottom in rates was hit in July 6th of last year at 1.37 on the 10-year.
Right.
So we're at 235, 240,
right,
thereabouts on the 10-year. It's creeping up gradually, and it's going to be a jagged move. But I think we're in a long uptrend in rates. It's just going to be gradual and slow. We have, as you pointed out, low rates around the world. German bonds just hit a record low, and that's anchoring our yields down, but the trend is still up, in my view. So I think we're in a bear market in bonds. We're short, very short duration in the bond portfolios that we're in.
In some ways, it perhaps is good to have a cap on those yields, though. I mean, especially if we want to do all this spending.
You're exactly right, and if we want to continue to have a bull market. So, you know, it's fine that interest rates go up gradually, both short and long, but if they spike, that's the end. That's what tends to cause market crashes, and that is a risk.
We don't want that. All right, Martin Sass, good to see you. Thank you so much. All right, we're going to have more Wall Street Week for you after this.